Over the past few weeks on this channel, we have talked about a lot of big changes hitting American wallets. We broke down the Federal Reserve rate cut. We talked about the confusion inflation picture, the credit and the debt pressure, the cost of living squish, and the way families across the country just trying to stay ahead. And every time we look at one of those stories, I always ask the same question. Okay, but how this actually hits your wallet? Well, today's story is one of the most people never seen coming. Because while everyone is focusing on mortgages, rent, groceries, credit cards, and jobs, there's a shift happening quietly behind the scenes that affects every single person who has a savings account. When the Federal Reserve cuts interest rates, most people think it means relief, lower payments, more affordability, a break. But for savers, for families trying to build emergency funds, for retirees depending on interest income, it's the opposite happens. There's a hidden transfer of money that begins the moment the Fed makes its announcement, a transfer from regular Americans directly to the very banks holding their savings. So today I'm going to show you exactly how that transfer works because it's already happening. So when the Fed cuts the rates, banks' borrowing costs falls instantly. That's the part we hear on the news. But here's the part banks don't say out loud. When borrowing gets cheaper for them, they don't immediately lower what they pay you. In a high-rate environment, banks fight for your deposits. They offer 4%, 5%, sometimes even more, because they need your money. But when rates fall, that competition ends. And that's when the quiet transfer begins. This is the part almost nobody knows. When the Fed cuts rates, banks immediately pay less to borrow money from the other banks. But they delay lowering your savings rate. This delay, sometimes weeks, sometimes even months, creates a window where banks pocket the difference. So billions of dollars quietly move away from savers and into the bank profits. So long before your savings account updates its APY, your bank earnings goes up because your savings earnings goes down. But you won't see it until your next statement. Most people don't check their savings rate every week. Banks know this, so the people impacted most are like the families with emergency funds, older Americans relying on interest income, anyone renewing CDs in 2025 or 2026, people who stick with the big banks that drop rates first, high yield accounts that pay 5% just a week ago, will quietly fall into 4, then 3.5, then 3%. And because it happens slowly, it doesn't feel like a loss, but it is. This is how the system preserves itself, by counting on people not paying attention. This is the part rarely talked about. If your savings APY drops from 5% to 3%, your money is earning 40% less overnight. A family with $10,000 in savings might lose hundreds of dollars in growth each year. A retiree with $100,000 could lose thousands, but because it doesn't show up as a bill or a price increase or a big expense, people don't feel the loss. This is how wealth erodes silently, not from one big event, but from slow, quiet changes that compound over time. This isn't a financial advice. Everyone's situation is different, but there are things people look at when savings rates start dropping. Shopping for banks that lower APYs lower. Locking one last CDs before rates falls further. Splitting savings between flexible and fixed options. Checking their APY monthly instead of yearly. Noticing which bank reacts instantly and which don't. The goal isn't to chase tiny percentages. The goal is to stay awake so your money doesn't shrink without you realizing it. Rate cuts makes the headlines, but the impact on savers rarely does. Savings rates drops quietly, growth slows quietly, banks benefit quietly. Americans feel it only months later. So when their accounts grew less than they expected, not every hit to your wallet shows up as a dramatic change. Sometimes it shows up as an interest you didn't earn. So if you have a savings account, a CD, or an emergency fund, pay attention in the next few months because the quietest losses are the ones that adds up fastest. Thank you for watching.